Most people dream of making money in the stock market. They imagine buying a stock today and watching it skyrocket tomorrow. They picture themselves retiring early, traveling the world and living life on their own terms. But the truth is very different. The majority of investors fail in the stock market. Some lose a little, some lose a lot, and very few actually build long-term wealth. Why does this happen? Why is it that despite all the books, courses, videos, and so-called gurus teaching investing, most people still can't succeed? Why do people continue to make the same mistakes over and over again? The answer lies in psychology, behavior, and human nature. The stock market is not just numbers on a screen. It is not just charts, graphs, and financial statements. The stock market is human emotion on display: fear, greed, hope, and panic. And unless you learn how to control these emotions, the market will control you. Most investors fail because they chase quick money. They want to get rich overnight. They see a hot stock on the news or trending on social media, and they rush in without research. They buy when everyone is buying, and they sell when everyone is panicking. This herd mentality destroys wealth. When you follow the crowd, you are always late. You buy at the top and sell at the bottom. And by the time you realize it, your money is gone. Another reason most investors fail is lack of patience. The stock market rewards the patient, not the impulsive. But patience is hard in a world of instant gratification. People want results now. They can't wait 5 or 10 years for their investments to grow. So they jump in and out of trades, chasing short-term profits. They try to time the market, predicting the highs and lows. But timing the market consistently is almost impossible. Even the smartest investors in the world can't do it. So why do average investors think they can? Instead of compounding wealth slowly over time, they gamble with their money. And gambling usually ends in loss. Emotions are another major factor. Fear and greed drive almost every bad decision in the stock market. When stocks go up, greed takes over. Investors think they are geniuses. They believe the price will go higher forever, so they buy more at inflated prices. When the market crashes, fear takes over. Suddenly, the same investors who were confident a week ago are panicking. They sell everything at the worst possible time. They lock in their losses, and then they promise never to invest again. The cycle repeats over and over. Buy high, sell low. It's the opposite of what successful investors do. Another reason people fail is lack of education. Most investors don't truly understand how the market works. They don't study company fundamentals. They don't understand financial statements. They don't know how to analyze risk. Instead, they rely on tips, rumors, and hype. But the market doesn't reward ignorance. It punishes it. And when you invest without knowledge, you are simply handing your money to smarter investors. Discipline is also missing for most investors. They don't have a clear plan. They don't know why they are investing in a stock. They don't set entry and exit rules. They don't stick to their strategy. Instead, they make emotional decisions in the heat of the moment. Imagine going to war without a strategy. That's what investing without discipline looks like. And most people lose that battle. Another trap investors fall into is overconfidence. They make a few good trades and think they have mastered the market. They take bigger risks, leverage their positions, and ignore risk management. Then one bad trade wipes out everything. The market has a way of humbling even the most confident investors. Lack of diversification is another killer. Many investors put all their money into one stock, one sector, or one trend. If it works, they make money fast. But if it doesn't, they lose everything. Smart investors diversify because they know the future is uncertain. But greedy investors put all their eggs in one basket and hope for the best. Most investors also ignore fees and costs. High brokerage fees, mutual fund expenses, and hidden charges eat away at returns. Over decades, these small costs make a huge difference. Yet many people never pay attention until it is too late. Another major reason people fail is short-term thinking. The best investors think in decades, not days. But most people want quick wins. They obsess over daily price movements, watching the stock ticker every hour. They panic when their stock drops 5%. They celebrate when it rises 5%. But these short-term movements mean nothing in the long run. Wealth in the stock market is built by holding quality assets over time. but few people have the patience or discipline to do it. Media hype is another trap. Financial news networks, YouTube channels, and social media influencers often focus on fear and excitement. They exaggerate stories because panic and greed get views. Investors who follow this noise end up making emotional decisions. They chase trends instead of building a solid foundation. Many investors also fail because they do not control risk. They invest money they can't afford to lose. They use credit cards, loans, or borrowed money to buy stocks. When things go wrong, they are forced to sell at a loss. They treat the market like a casino, not a wealth-building tool. Successful investors always manage risk. They invest only what they can afford. They set stop losses. They balance their portfolio. But most people ignore these basics until it is too late. Another key reason people fail is not understanding compounding. They underestimate how powerful long-term growth can be. They sell too early. They withdraw profits instead of letting them grow. They don't give time for compounding to work its magic. Albert Einstein called compounding the eighth wonder of the world. But most investors never experience its full power because they lack patience. Greed also leads people into dangerous traps like penny stocks, speculative initial public offerings, or meme stocks. Yes, a few people get rich overnight, but most lose everything chasing these risky bets. The stock market rewards discipline, not gambling. Some investors fail because they copy others blindly. They hear about a friend making money in a certain stock and they rush to buy it too. But they don't know when their friend bought it, what price they paid, or what their plan is. By the time they join, the opportunity is gone. Copying others without research is a recipe for disaster. Another issue is lack of consistency. Investors stop and start depending on the market mood. They invest when the market is booming. They stop when it is crashing. But real success comes from consistent investing, month after month, year after year. Even when the market is scary. Even when everyone else is selling. Fear of missing out, or FOMO, also destroys wealth. When investors see others making money, they feel pressure to jump in. They buy at the peak just because they do not want to be left out. But by then, the smart money is already leaving. Another hidden reason investors fail is lack of clear goals. They don't know why they are investing. Is it for retirement? For buying a house? For building long-term wealth? Without a clear goal, they get distracted by short-term noise and lose focus. Taxes also play a role. Many investors forget about capital gains tax and end up shocked when tax season arrives. They trade too much, triggering unnecessary tax bills. Smart investors think about after-tax returns, not just gross profits. Psychology, more than knowledge, is what separates winners from losers. The market is designed to test your emotions. It will tempt you to buy when you should sell. It will pressure you to sell when you should hold. It will make you doubt yourself in every downturn. That's why most people lose. They can't handle the psychological game. But here's the truth. Failure in the stock market is not inevitable. You can avoid these traps if you have the right mindset and strategies. You need patience. You need discipline. You need a clear plan. And you need to stay calm when everyone else is panicking. The best investors in history, Warren Buffett, Charlie Munger, Peter Lynch, did not succeed by being the smartest or fastest. They succeeded by avoiding big mistakes. They stayed disciplined. They thought long-term. And they kept their emotions under control. If you want to succeed where most fail, you must stop chasing shortcuts. Stop chasing hype. Stop following the crowd. Instead, build a strategy. Invest in companies you understand. Hold for the long term. And let compounding do its job. It won't make you rich overnight, but it will make you wealthy over time. The stock market is one of the greatest wealth-building machines in history, but only for those who know how to play the game. Most people fail because they play with emotion, not logic. They want excitement, not discipline. And excitement is expensive. The winners are the ones who stay boring. They buy quality assets. They hold them for decades. They ignore the noise. And they let their money work for them. So the choice is yours. Do you want to be like the 90% of investors who fail? Or do you want to be among the few who actually succeed? The difference comes down to discipline, patience, and mindset. If you can master those, the stock market will reward you. If you can't, it will punish you. Remember this. The stock market doesn't make people rich or poor. It simply transfers wealth from the impatient to the patient. So be patient. Be disciplined. And don't let emotions control your decisions. Because in the end, success in the stock market isn't about beating others. It's about beating your own worst instincts. If you found this video helpful, make sure to like it. Subscribe to the channel for more insights on investing, money, and building wealth. And comment below, what is the biggest mistake you have seen investors make?